Hello, hello, good morning, good afternoon. Let me make sure we don't have any tech problems. Um, Everyone can see the document. And can you guys hear me? Okay. Uh, yes. Good afternoon, Rameshji. Good morning, Ravi. Yes, and yes, thank you for confirming. Um, Let me make sure that you guys can also speak and I can hear you. So you should be able to. Or can just someone just holler me hello so that I just make sure that audio is
Hi.
okay from
Hello.
my side.
Hi,
Hello,
Vivek.
Vivek. Morning.
Morning, morning. Good one, good one. All right. Looks like all good from tech perspective. Okay, so what caught your eyes, guys? Another week, another all-time high. What's
Uh,
happening?
Vivek, I
Yeah,
just caught that headline today. So what does this mean? Harvard buys more into I think it's
yeah,
BlackRock, Bitcoin. Then
yes.
so what do you take of it?
My takeaway is remember, right, where the big money lies, pension funds, endowment funds. Getting endowment funds to change their investing philosophy is very difficult. So looks like BlackRock has done a good job of convincing Harvard um, Investment Management Committee, saying, "Hey guys, you should have their IBIT, which is Bitcoin ETF, on your balance sheet or basically on your investment," which is a
ਇਹ
great
ਰਮਨ ਉਹ
move
ਸੂਟ ਆ
from
ਜਿਹੜਾ ਤੇਰਾ ਪਹਿਲਾਂ ਕਿ ਨਵਾਂ ਸਮਾਇਆ
Harvard perspective. Hey, I'm getting some background noise, so I'll have to mute. Yeah, if you're not speaking, please stay on mute. So that's a great news, especially for those folks who have been on crypto side, right? But is it like it's like 117 million only, which is not huge, but it's a token from a token investment perspective. I think it's more of a it's a good signal than a financial number perspective, right? Because most of the endowments generally have a lot of investments in private equity, real estate, venture capital, and a lot of alternatives stuff. So
Excuse
now
me.
crypto asset is considered as an alternative, and
But what
seems to be an accepted one. So why not?
but what does it mean topping its stakes in Google and Nvidia? You mean they didn't invest I mean Nvidia it's gone up like 44 times the past 3 years. And
Yeah.
so that means they don't invest in Google and Nvidia that much. Sorry, I didn't read the article.
So they may not have a direct investments in Google and Nvidia, but let's say they might have invested in other funds that those could have invested in. So I think this is how the headlines the media will write it, right? Otherwise, why would someone read it? Howard pours 117 million. Just looking at this, more exposure to top than stakes in Nvidia and Google parent Alphabet. Right? So maybe the direct investment in Google and Nvidia may be less than 116 million. But what if I don't know what the Harvard stake is, but what if they hold a lot of QQQs on their balance sheet? Right? But if they don't write this headline, it won't be that catchy. So, but I think overall from a signal perspective, it's a it's a good signal because now we are seeing that some of those who are those institutional investors who are tough to please or difficult to change their investing profile now actually I consider that this crypto asset is a real asset, right? It's not only for degens or not only for technocrats or for um, criminals. It is actually has become an asset just like 30 40 years ago real estate became an asset on the investing portfolio of many endowment funds. So now this has also become an asset. So I would see this as a validation, and what the proponents of crypto economy have been talking about it. I mean, yeah, Brown University. At the end of the day, I will expect every university, or forget about university. I think every investment manager will try to get an exposure to it. Otherwise, how do you explain and go back, to your investors, or if you're an endowment fund, to your whoever you report to, saying, I did not have any exposure to this asset class, which is now being given legitimacy by the administration, by the government, and it has been the best performing asset class for last 15-20 years. It's become, it'll become very difficult to explain, and it will be like you might lose your job, or you might get sued for not doing your work properly or not being fiduciary if you do not have exposure to this. Slowly, it might end up into that phase, and then every fund manager would say, you know what, not, maybe I want to have some exposure so that I can see CYA. Or it's like, what, in 1960s, no one get fired for buying an IBM stock? Maybe we'll reach at that level wherein no one will get fired for not for having an exposure to Bitcoin, because hey, it's been the best performing asset class. Anyway, so yes, that's one big news. There's a lot of other stuff I'll cover on the crypto side, which happened this week. But yeah, this is a big news. What else?
Hi Vivek, it's Ravi.
Hey Ravi, how are you?
Good. How are you today?
Good.
Thanks for your timing. I heard today's Ethereum is going up. I heard BlackRock is buying more.
Yeah,
Is that right?
We'll talk about it. We'll talk about it when I'll cover the crypto side. Yeah, so Ethereum.
Thanks.
Yeah, so we'll cover crypto asset. We'll talk about Ethereum. Just remind me to answer the question. Okay. So what do you have? So let me see. Anyone joining here for the first time?
Yeah,
it's
I
me.
think the first time.
Sorry.
It's the first time.
Okay, I heard Arun.
Yeah, I'm first time too.
Yeah, my name is Haroon and I'm joining for the first time. It's a pleasure to be here. Thank you.
Cool. Yeah, we probably have a time for a couple of introductions. Would like to know, what brings you here and what are you interested in and what kind of investor you are. Like when I say what kind of investor, are you day trader, swing trader, or long-term buy and hold, or, hey, I'm just exploring. I don't even know. I have to figure out. Anyone? New joinees?
Oh, yeah, I can. So I am here because I'm interested in investing. I'm not very well versed in this area. So I thought I'll join this meetup and learn some language and some information about the topic.
Cool. Welcome.
Thank you.
Arun.
Hi. This is
So yeah, my name is Tarun. I'm also in the same field. Like I'm the very just starter. I'm looking for some. What they call the investment techniques or investment strategy. Just want to learn how the expertise like you guys are making a decision or making the investment on the sector, right? So those techniques I want to learn, and then I plan for my future.
Cool. All right, one more. Mithun?
Yeah, hi. So I'm Mithun. So this is my first time joining. So I'm usually the last few months made a bad decision and lost some money trusting somebody else. So I just want to get back started. Basically, I'm like a buy and hold person, and also want to do some explore other like options and swing trade and stuff. So I think it's like a fresh start for me.
Cool. Yeah, one thing I think which we should keep in mind is no one cares about our money as much as we do. So that's why I want to just focus on managing money, my money myself, become the best retail investors, DIY retail investor. And that's the focus of for me. All right, good to have you guys here, and welcome. You're joining it for the first time. Hopefully, you will find something that is useful for you, and I'll get to meet you again, next week as well. So with that, let's talk about today. What's on agenda today? As you guys know, this is an earnings season. Probably, I think next week also we'll have a few earnings and then it will die down. So most of the time that I spent this week was going through the earnings of many companies. I think last week I talked to and mentioned you these are the companies and this is what I want to focus on when I'm reviewing the earnings of those companies. So anyway, a bunch of earnings we're going to review today. You can see the list right out here. What we got: 1, 2, 3, 4, almost 10 companies, and then I added a few more, 4, 5. Not going to go into the detail, but just a high level overview of 4, 5 another companies, because I was reviewing last week messages and say what are the answers that I did not respond to, and then I saw that some of you had mentioned apart from the companies that I told that I'll be reviewing, you also mentioned some of the other tickers that you guys were interested in. So I thought, okay, let me add that as well. So a lot of earnings to review. And then I think that's the main stuff. Then obviously, as always, I'll start with overall a weekly market wrap in terms of TradFi and crypto, some interesting charts that I might have to share. And if you have any questions around options or investing in general, just put it on the chat and we'll take it from there. But largely today is focused on earnings. TTD is missing. Good catch. No, I think I have TTD, right? That's because that's the one which I have done a deep review myself. So I have it here. The logo is, you may have to go back and look at the logo. TTD is there. Okay, anything else before we get on to today's session? What else? What else caught your eye? What's in your mind? Anything you thought you want to talk about it today? Come on, that's your opportunity to change the course of our discussion today.
Can we talk more about I was reading more about ETFs, and last week you shared your portfolio, which is a combination of like stocks and ETFs, and just the balancing of it. I was trying to figure out, I guess there's certain ones that you could have like high dividend rates and like lower ones, and so trying to understand a little bit more about like balancing your portfolio with ETFs and what that looks like.
Okay, so maybe we can start our discussion with that on general on ETF. Okay, so I'll start with that, and then we'll get into the regular topic. Cool. All right, so with that, let's get into our discussion for today. Welcome, everyone. This is our session number 287. Very soon, we will be hitting 300, 300th number. So that's like almost, six and a half years it would be. And glad to, have you guys here. And at least this is our investing dojo, and where we get together, talk about stocks, bonds, IPOs, crypto, anything and everything under the sun, which as a retail investor, we can invest in. So thank you for showing up every weekend. As always, anything that we discuss here is only for education. So don't go and invest solely based on what you hear. Do your own due diligence. And if you like what we're talking about it, spend some time to understand that company in detail. All right, so let me first answer a question that I don't think I answered. I did a good job of answering in the last session. So Jim, do we have Jim here? All right, but I think this probably is also useful for others. Sometimes if the person who asked the question is not here, I'll skip it. But I think this is pretty generic one. So the question was, can you tell us your favorite fundamental metrics to look at stocks, top 5 fundamental metrics? So this is how, when I'm looking at any company, I'm trying to do my research apart from, the business competition, etc. But when it comes to the fundamental, what metrics I look at, I want to look at, does this company have a moat? Which, gross margins and the return on invested capital will tell me. I want to look at, does this business has a secular tailwinds, which I'll find out from if the revenue is growing or not, right? If the revenue is not growing, maybe there is no secular tailwinds. Market might have matured. Doesn't mean that the company is bad, but just give me an idea of if the overall market itself is growing, and if the revenue is growing, it means there's a lot more runway for this company. Third, I also look at profitability. Right? Is this how profitable the business is? You can look at operating profits. I also look at operating as well as net, but I focus more on operating profitability because net profit is more of an accounting profits. I also look at, how capital intensive the business is. Does it need more capital to give me those profits, or if it is a less capital and can give me the similar amount of profits? I would like to invest in a businesses which consume less capital. Right? But in case if there are businesses in which the capital itself, the requirement of a heavy capital, huge capital itself become a moat, then yes, I'll be open to investing in those businesses. If you look at all the AI stuff is kind of become more, right? You need to at least have $100 billion of your balance sheet before you start to play in the LLM, basic LLM models. Right? So that has become a moat. And we are seeing from all these hyperscalers in terms of how capital intensive this business is. Right? So in some cases, depending on a business type, some in cases, the capital intensity could become a moat, but otherwise, I would love to have a businesses which are light balance sheet, but still generate good return on capital. Right? Then look at your capital allocation. How good the management is in allocating the shareholder capital. Are they going to go out and just acquire some companies which are unrelated to the businesses, or are they going to returning the capital to shareholder? Are they going to conserve the capital to grow the business? Those decisions. Right? Finally, also the cash flow generator. Is the business generating cash flows or not? Right? So these are like the top 5, 6 things I look at, and then I have my own metrics to figure out, is this company deserve further analysis or not? So when I look at this profile, it's not that it's automatically no or yes from an investment perspective. I have seen that there are some things which I will immediately look at this and say, you know what, I don't want to touch the business. So there are cases where it could be automatic rejection, but it's never automatic yes. So if a company that appears good on all these metrics, then I would say, I think it does deserve more attention. Now let's get into deep dive in terms of understanding, the company profile, competition, go through past couple of years of its annual reports, look at the, 10Ks and all that stuff. So I first look at some of these metrics before I decide to spend, many hours on the company and reading through this, its annual and quarterly reports. Okay, so hopefully that answered the question. So Vishal is asking, can you please elaborate capital intensity?
So Vivek, I have a question there. This is Vishal. So when you say capital intensity, are you thinking of the return on investment, how much capital they're burning, and out of that, how much money they're earning, right? So it can be tied to the return on investment. So, and that kind of see how profitable the company is, but again, at what cost?
So,
is that how you're saying it? Or
so when I say capital intensity, I basically look at in terms of what's their capex as a % of their revenue would be. right? If they continue to maintain the business, if they continue to invest in basically on their capex, that it means what remains to us, eventually it will turn out to be return on invested capital, right? But I will look at what the capex is, how much capex do they continue need to invest,
Gotcha. Thank you.
right? Capex or and slash or OPEX. So if there are two businesses, both are having, similar revenue profile and the margin profile, I would prefer the business which is a lower capital intensive than the business which is high capital intensive. Except the case, in let's say that's why I say it's never absolute yes. But let's say if there's a company which is building LLM models, and of course that is more capital intensive, I will go ahead and do it. But not, assuming everything else stays same, yeah, less the capital required in a business to generate same kind of a profit margins, better it is for me. Okay. All right. Anything else? Okay. So moving forward, this is 1 year anniversary. Does anyone remember? We talked about it last year. What am I referring to here? Something happened last year in this week, in which the stock market was down almost 8% in 3 days. Come on, many of you were here. We talked about it in this meeting, and then we also said, hey, don't panic. Just go and look at your own individual profile and see if that thing impacts your profile.
The Japanese yen thing.
Exactly. So I think it was on what, 5th of August, where we bottomed because the yen carry trade blew up. Japan increased their Bank of Japan increased their whatever the equivalent of Fed rates by, I think, 25 or 50 basis points, which is a huge, considering the fact that Japan had for many, many years, they kept it at 0. And it was a very, I was saying, well-oiled carry trade that many, many hedge funds and the institutions have had become used to over years, which is basically borrowing Japanese yen and investing on the US market. And when the borrowing become a little more expensive, all those trade blew up. So we saw a huge, in 3 days, market lost almost 8%. And that time when I was looking at my portfolio, I'm like, I don't have many companies that are actually are invested in Japan or have borrowed in Japanese currency or have a yen holdings or a business in Japan. And when market goes crazy, it will punish many of the companies irrespective of whether that is impacted by it or not. So it was a good time to, a market gave opportunity to buy those good businesses, which then recovered nicely. And if you plot what happened since last August to end of this week, market is up, I think, 25% since then. So, yep. It was not a happy wasn't the best meeting that we had after this yen carry day blew up, because all portfolios were in the red for the week. Unlike, which is very different, hopefully, this week it's completely 360-degree or 180-degree opposite what's happening in the market, which is this week it's another all-time high. I think SPY is up, what, 2%? This or maybe something around 2%, and QQQ is up like 3 or 4% for the week, right? Very different scenario. Aditya, capital intensive can be a mode. Yes, that's what I talked about, right? In case of, let's say, LLMs, etc., it could become a mode. So it's not 100%, binary decision based on what I see on these, but it's a binary decision sometimes on rejection, right? If I see a company that has never made any operating profits over last 10, 15 years, or they're, profit or the revenue is not growing, and nor they're making any profits, I'll just reject the company. All right, so let's look at what's happened on the TradFi market at a macro level. Services sector, which is 71% of US GDP, it has expanded, right? So, and the services purchasing PMI, Purchasing Manager Index, is a new high for the year end 55.7. So we continue to have expansion on the US market, despite all the things that we have heard around tariff and whatnot. Services sector is still continue to expand. So if you're wondering why the stock market is where it is, yeah, there are some tailwinds behind it. And we'll look into it in terms of the earnings. Earnings continue to surprise us to the upside. Right? So equity markets, remember last Friday, we ended up in red, and then the dip was, quickly bought over this week. So the markets are rebounded. The best performings were technology and the consumer discretionary. The dip was bought. 70% of the companies have reported for their Q2, and their earnings looks pretty healthy. I think I do have a chart somewhere which talks about, in terms of the earnings growth, and they have all beaten estimates. Majority of the companies have done better than what their forecast was. 63% have beaten the forecast, only 10% are missing. And when you look at a sector specific, let's say if you look at a tech sector, technology company, maybe software companies, the numbers are even higher than 60%. So almost 2/3 of the companies in S&P 500 have beaten their forecasts in terms of the earnings. Right? Now, this has been the best ratio. This is an interesting chart from Goldman Sachs. In terms of number of companies that have earnings surprises on the positive side, 63%, and misses are only 10%. Right? So why not? Maybe the market is, front ran this outcome, and that's why the market is where it is. Now looking at year-over-year EPS growth relative to expectations, we were expecting 4% year-over-year growth in Q2. That was what the overall analyst expectations was. And so far, we're delivering almost 9%. Right? So you're doing better than what the street was expecting. And now we have revised the growth for 2025 to be almost 10%. So earlier we had like 3.8%. When I think the Liberation Day and everything, that was passed, or maybe a little before that. So we were only focused on maybe get around 4% growth in earnings, which if you look at if the inflation is at 2.5%, right? The real growth is only 1.5%. Now we have revised it. The Wall Street has revised the growth targets to be almost 10%. So market continues to go high. S&P continues to go, I think it's close to its all-time high, not really all-time high. If you look at S&P 500, only if, alrighty. Yep, the all-time high, 640, close to 640, but we are pretty close to the all-time high. NASDAQ, on the other hand, and I'll look at QQQ, is actually hit a new all-time high. QQQ is 574. Right? This week is all it's all up. So pretty good, right? And NASDAQ is what, 12.5% up for the year. And I forgot to look at SPY. SPY is almost 9%. So it's like a 1% every month right? So almost we're eight months in, market is up almost 9%. I wish the investing life was so simple that we just go 1% up, but it wasn't that the case. It wasn't that case. You've seen all the volatility in the market, the dip that we have, almost 20% dip. We entered the bear category, and then we rip with a V-shaped recovery, which no one expected. Especially none of the Wall Street firms had expected, especially the Goldman Sachs, which now have all these fancy charts. But after Liberation Day, I think they kept revising their end of a year target like 4 times. Every week or every day, president will come and say something new, and Goldman Sachs will come and revise their end of a year targets. That's why it is almost impossible to invest based on these macro news, right? So leaders have been tech and the communication sector, and the laggards have been energy, materials, and healthcare for this week. So that's on equity side. And again, we will review a lot of these earnings. On the bond side, it was a little not that happy situation. So there was almost $42 billion of 10-year notes and $30 billion, $25 billion 30-year bonds that government wanted to raise, and there was a weaker demand. We did not see the demand was not strong, especially from foreign buyers. So a US bank, Fed, as well as the corporates had to step in to basically take those notes and the bonds. So the rest of the world is not that keen on owning US debt. So, which means the cost of servicing the debt will be a little higher. And it's because maybe the world is, again, this is just this week auction. Maybe the things will change next week, but the concerns around the deficit and continuous increase in on US debt level, which is what we are seeing. Hold on, there is a US debt clock. I don't think we have looked at that for some time. So let's bring that up. Wow, we have now hit, I don't know how to close this ad, but anyway, we have hit, congratulations, we have hit 37 trillion now. Isn't that crazy? We were just talking about, I remember discussing 30 trillion. Oh, come on, it's too best. Now 32 trillion, 35 trillion. Now we hit 37 trillion, which is again a new all-time high for US debt. Not a happy situation. And that is why I think we are also seeing some of the real asset or inflation hedge assets like gold and now the Bitcoin also being, I can't say the gold is, I think is performed really, really well. And as well as Bitcoin is near its all-time high. I'm surprised to see that the gold is not higher. I expected maybe GLD will be higher than this. And if you look Bitcoin, let's take a proxy BTC futures. Yep, 117K. So there are a little concern around what our government gonna do. And that's why some of the bond, the demand was less and the yield was higher. Also, maybe the bond market is also pricing in the fact that we're gonna get a rate cut in September. I think for now it's given. And if we don't get a rate cut, that's not gonna be good for the markets in September. So CME Fed Watch 2, let's look at, I think last week we looked at it was what, 70% or 80%. Let's look at the probabilities of a rate cut. Now we are looking at 90%. 90% we're pricing in that we will have at least 25 basis points rate cut. And now more interesting is to see here, which is that even in October, we're expecting another rate cut. But so this is but given, and I think probably we will get it. And if the labor, I think when the August report comes out in terms of labor statistics, and if we see that the labor is weakening, the labor situation has become worse than what we discussed last week for July, all those revisions, those downward revisions, I won't be surprised if we actually get a 50 basis point cut. So, but I think 25 basis points is market is already assumed. 90% probability that we're going to get a 25 basis point cut in September. But if the labor condition deteriorates, we might get 50 basis points. Right? And that will rip the markets. Because we still have close to $7 trillion sitting in the money market funds. Now, if Fed reduces the rates by 50 basis points, eventually those banks and institutions, they will also reduce what you earn on your money market funds, and that money will move somewhere else to find the yield. Right? And that might come on to the markets. So that's why I'm getting some annotations. So Shrikant, where were you doing? Let me clear this out. So despite all what I'm seeing, that the markets are all-time high and whatnot, I think it's difficult for me to turn bearish. Just based on, how much money is sitting on the sidelines and the fact that we still hear from the markets and a lot of, investors saying that it's too much too soon, markets are overvalued. We'll look at some charts. So there's still a lot of cautiousness and including me, right? Saying, oh gosh, I think this is too much too soon. Markets are overvalued and all that stuff. And when everyone is saying it's easy to make money, when everyone is bullish, that time I can say, hey, the bubble is starting to form, right? There are still a lot of people who are bearish in the market, right? And have sat out, especially, the big money who probably sold their portfolio after the bloodbath in April and thought they will get back and never got an opportunity to get back. And how long can you wait on the sidelines before you throw in the towel and say, you know what, I am getting in. Let me buy, let me try to, get back into the market. Anyway, so a chart on tariffs. So right now we're looking at, for most of the US trading partners, so what in April, there was a baseline tariff of 10%. So it looks like majority of the partners will have 10 to 15%. And then I don't think even this is 50%, probably still getting negotiated with China. But I think on an average last week, we looked at 18% on average comes out to be 18%, which is the highest since 1930s. But it is what it is. Right. And then another news on the tariff was 100% tariffs on semiconductors, but with a catch that if you plan to manufacture in US, if you're manufacturing in US, or at least if you have a plans to manufacture in US, or if you can just come and say that you want to manufacture in US, your company will be exempted. So, and I think once this was announced, we saw some of the semiconductor stocks, they ripped higher, stuff like TSMC, which is building plants in US. It was up like 5-6% after this announcement. We saw Nvidia and some of the other chip stocks also ripped higher. With at least some production in US, they will receive exemptions. Unfortunately, other company on the chip side, which is 100% US based company, Intel, it hasn't found its mojo yet. So that's not working out for Intel. We also saw President launching a direct attack on Intel CEO Lip-Bu Tan, saying he should just resign because of his ties with China. So if you go back and look into the history of Lip-Bu Tan, he's been a venture capital, and then prior to that, he was also a CEO of Cadence Design Systems. And I think there were some cases around Cadence that they had supplied their own software and technology to some of the Chinese companies that could be affiliated to Chinese military. Nothing had been proven. They never supplied to a country or to the companies on the entity list. But there were some allegations. I don't know what happened. And also as a venture capital, he has some investments in some companies based out of China. Again, none of those companies have been banned by Department of Treasury or put on the entity list. So I think as a US citizen, if it is not banned, you should be free to invest. But anyway, that didn't stop President to take on Lip-Bu Tan, saying he should just resign. Anyway, you guys know Intel stock hasn't been doing that great.
Vivek.
The whole story of 1 second. The whole story of a US chip company has been a sad story, unfortunately. Yeah, go ahead.
Yeah, yesterday there was an article that Malaysian and Singaporeans are pointing out about this racism that Trump is obviously bearing his ugly face about again.
Oh, baby, man, I don't care about the media reports, what they do or what they're not, and if it is more of a political news, I would care.
The thing is, Intel would have definitely gave him a hard look. I mean, more than Trump would only do in his overview. And yeah, I do take this personally, what he's doing with this stuff.
Yeah, I don't agree that any. I mean, in any case, the president of a US should tell a CEO of a private company that they should resign or not. In case of a Lip-Bu Tan, I mean, yes, he had investments in some Chinese companies. He had affiliation with some organizations, but none of them have been banned by US, right? So it's an overreach, but our president, he'll overreach in every aspect, right? Doesn't really matter whether it is related to China or whether it is related to some in Middle East. He is what he is. So I don't want to add any more color saying it's a racism or anything else. But when it comes to this president, these things are not out of bounds. Well, I mean, I'll discount whatever he says or does anyway. So what other thing we saw? Tim Cook, right? Look at an Apple stock. What Apple did. Let me just bring up PL. If you look at Apple stock, it's up 13% in what? Last 4 days. Eventually, I think everyone has to kiss the ring. And that's what Tim Cook did. Remember, so they presented a plaque to president in which the base is of 24 karat gold, right? That net Apple announced additional $100 billion of investments in USA. I think this is probably in collaboration with their Corning to make these the glasses for iPhone, I guess. And this is on top of the investment that they had announced earlier of $500 billion and then he went to White House, and the stock is up 13% in a week. Now, the major reason why the stock is up was probably Apple will get an exemption on the tariffs that now President put on India. I think it's a 25%. Remind me, where did we end up with? Because this situation keeps changing. Did we say 25%? What did the president eventually say? Is 25%, 30%? Now it says up to
50%. Yeah,
up
I
to
think it was
50%.
25 plus 25 due to the penalties.
Yeah.
Oh, yeah.
August 6, additional 25%. Oh, for buying the Russian oil. Okay.
Yeah.
So the 25% is general one. Another 25% is for, I think there's a specific name to this stuff. So now it says 50%.
Yeah.
And if you recall, after the COVID, when the administration was saying to every major company to de-risk China, a lot of companies had moved their supply chain to other Southeast Asian companies, and Apple had moved a lot of its stuff to India. And now if there's going to be a 50% tariff on goods coming from India, that's not going to be good for Apple. Probably now they will get an exemption because, hey, we announced some stuff here. And number two is Tim Cook went to White House and kissed the ring. And so the stock was up like 13% just on this news. Nothing specific, nothing changed from Apple business perspective. Last week, we did look at Apple results. I think other news that was positive for Apple has been that their China sale, the revenue from China actually grew year over year, even the recent quarter, and that has been declining for past, I think, 5-6 quarters, right? So China story has been pretty bad for Apple over past few quarters based on what's been happening in China, and of course, a lot of competition coming from the local handset makers. But this quarter, Apple actually grew, right? Of course, they had an easy comparison with previous year. But in any case, I think the headline number was Apple's China story is back on track, kind of a thing. And the market liked it. However, if you look into the details of it, the reason why Apple China revenue grew, because now Apple actually participated in the subsidy program that Chinese government runs from time to time to stimulate the economy in China. So basically, Chinese government, and I forgot the numbers, maybe 300 billion yuan or something. What the subsidy programs are for, these electronic goods, household appliances, etc., saying if you discard your old one and buy a new, let's say, washing machine, or you buy a new smartphone, and there are some conditions to it that the price has to be below this, and then the government will give you subsidy. So till date, China had resisted from participating in the subsidy program, but I think it was in May or June, probably in the second quarter, it actually participated in the subsidy program. And I think that was one big reason why the revenue from the China was up. But it also means that Apple is finding it difficult to actually compete with other programs without this subsidy stuff. So make what you want to make out of it. But that was one reason. In any case, it's up 13% a week. Not bad, right? And of course, the other stuff around China, around Apple is still, the biggest question that is lingering on Apple is what are you going to do with your AI stuff, which we still don't know. Other interesting chart, Eli Lilly had a bad week. And I think now looking, I know Novo Nordisk was pretty beaten up, has been a beaten up stock, but it looks like Eli Lilly also getting into the same boat. So what? The whole weight loss drug has now cooled down? Looks to be the case. So it looks like Novo Nordisk has traced back everything since what, last 2 years? Almost 2 years. All the gains from what's Novo Nordisk is Ozempic or Wegovy, one of these, right? All the gains from weight loss drugs have now basically Novo has shed the weight. Right. Let's look at Eli Lilly. LLY. I thought Eli was doing better and holding up better than the Novo because Novo couldn't compete against Eli. But yeah, it hasn't retraced fully, but I think the whole story around these weight loss drugs may be petering out a bit. Right. So that is why, I mean, I never invested in any of these two. I missed the boat, so I missed the boat. I just don't understand this healthcare and the drug space, and have seen these fads which will last for a couple of years, and then something new will come up. But I thought Novo Nordisk was challenged because they just couldn't compete against Lilly, but now it looks like Lilly itself is facing its own challenge. Any investor in these? If you can throw some more light on what's happening. I think Novo, I understand they are also had to change their CEO. They had some patent issues around Canada, and of course they're facing huge competition from compounding pharmacies. But what happened to Eli Lilly? Any investor in Eli Lilly here?
Yeah, I can talk to it a little bit. So, Lilly had this oral pill, and the effectiveness of the oral pill came below 15%. Like it came to 12% when the CEO had promised it will be 15%, which is why the stock is down. So, their original weight loss injection is doing okay. Like that's not
Okay.
an issue. Those sales and all that are good. But everybody was really excited about the oral pill, and the effectiveness of that came down to be very low, which is 12%. Like it doesn't feel low, like 12% and 15%, but they want it to be minimum 15% so that it's effective enough. And I think Novo's oral pill is around 15%. So that's the next growth that they're looking for, both of these like weight loss companies. And that's where this came up short, which is where it's
Okay.
going down.
Cool. Thank you. Yes, they'll have to move away from maybe injections to pills, make it easier for people to consume. And if that is not that effective, yeah, market reacted negatively to it. What else? So that reminds me of looking at a healthcare, right? Now, I also learned something new, how to draw the ratio of two stocks on Thinkorswim. So now the healthcare, the ratio of XLV and SPY, it's the lowest since almost 25 years. 25 years. Take what you may. It does make you thinking. Healthcare is still 17 to 18% of our GDP. So that number hasn't changed. But what has changed is in terms of what the market value or the market caps, or what's the multiples is the stock market is assigning to healthcare companies overall. Right? There will be some companies who have done great, some companies have fallen by the wayside. But as a sector, it is back to where it was 25 years ago as compared to S&P 500. Right? And I mean, it also includes United Healthcare, which is one of the biggest insurer and healthcare companies, and that it had, UNH is they just can't seem to find a bottom, right? From whatever 600 plus, it's been an ugly chart on UNH. Right? So, wow, close to 600 to now 250. Right? So at some point of time, you'll think, you know what, is it too much? Are we treating healthcare sector as how we treated financial sector after 2008 melt, 2007, 2008 meltdown? Again, I don't know. I don't have much insight into how the whole healthcare sector, so that's why I stay away from owning individual companies in the healthcare sector. But as a overall, to me now it looks like attractive. Again, not a financial advice. But market has a tendency to swing from one extreme to another. So I opened a short put position on XLV, looking at so which gives me some buffer. And again, I don't want to own individual companies, but I'll be okay to open something on XLV as an overall ETF. Right? Seems to be too much. Again, only future will tell whether it's right or wrong. But I always think in terms of probabilities. I'm not saying that it is too bad, but I think the probability is higher that in future we may see better days for healthcare. Probability is higher. There's no certainty. Shri is saying time to get long and hold for 3 years. Yeah, I mean, I'm gonna do on using the short put, and if we get assigned, I'll see what I will do with it. Dave, did you guys talk about TTD already? No, Dave, I will review TTD when it comes to the earnings. Long, if I long, am I catching a falling knife? I mean, I own TTD in my portfolio, so I will give you my thoughts on it. So hold on.
Vivek, on the healthcare topic, XLV, there are no sort of government establishing like regulatory ceilings on profitability type of concerns here, right? It's probably an emotional overreaction. And for example, I know the insurance companies just their max profits capped on premium, so that couldn't be a theme here.
No, but let's see what all is in XLV, right? So if I look at an XLV main holdings, Eli Lilly, Johnson Johnson, you see United Health Group, right? So and United has got a big insurance operations as well. But other ones don't have that of an insurance. But I think that right now the sector overall is depressed because of Maha movement from current administration, right? Which is, guys, we're gonna disrupt whole pharma industry. It's a pharma's industry's modus operandi has been not to stop you from falling sick, but to treat you once you're sick. So you know, right? RFK Jr. and all that. So I'm not for or against. I mean, every individual probably will have your own opinion on how you want to see the pharma industry. But I think currently, I mean, they have hold some good companies. I know Johnson Johnson is a good company, good dividend paying. Intuitive Surgical has been a good run. But I think the overall, if you look at this, that overhang of administration and what RFK Jr. might do is basically dragged on the whole sector. And that's why to me, it looks like, hey, won't hurt to give myself some room for error. And that's why I went with the short put and not the stock position. Dave, I've been holding XLV for a few months, just selling covered calls. Yeah, if I get assigned, probably that's what I'm gonna do. Maybe I'll sell strangles once I get assigned. If I'm looking to deploy new capital in the market, I will probably be looking at the companies which are unloved companies at this stage, which are very few, sectors which are unloved. Yeah, healthcare is one of them. Dividend companies are another one of them, which are unloved right now. But I have a lot of growth companies already. I don't want to add more, especially when the market is at all-time highs. So, but that's just me as an investor, right? And what my needs are. At this point of a time, I will do fine if I don't make any stupid mistakes. I don't have to win the game. I just have to try not to lose the game, right? So I will do the stuff which has got give me a good margin available for me. Another interesting chart, S&P near tech bubble. Again, I don't endorse or against this, but just an information. So what we're looking here, we're talking about S&P high versus March 2000, which was a tech bubble peak. And now you're looking at various valuation metrics or pricing metrics, I would say. Forward PE is 22.4. March was 24.2. Normalized PE is this. Peak was, we had almost 30 and 35. Looking at price to book, which I don't think you should look at when it comes to a tech company. It's a useless metric. Price to cash flow, we're just 1% away. It's actually from price to cash flow perspective, it's over valued, but we are not as pricey as tech bubble peak, but maybe a bit close. Right? If you just look at the number, that's what we'll say. Oh, come on, man! We're looking into we're staring into the .com peak. This bubble is gonna burst, but may not be. Maybe look at what kind of a company is that constituted March 2000 peak. What sort of a companies were there listed on NASDAQ? And what sort of a companies do we have now listed on NASDAQ? And I think I heard some stats yesterday. Top 10% of S&P 500 is now 76% of the market cap or something like that. Wow. And that's the highest ratio that's ever been in the history. Let me search top. Let's say top 10% of S&P. There's some news around it. And what's the overall? Oh, we can just do a quick calculation on holdings top 10%. Anyway, so but I think whenever we look at these numbers, we should also look at other related numbers to it, which is now when I'm looking at a price to free cash flow and all that stuff, the companies that are now constituting these numbers are very different. The companies that we are not talking about is companies like NVIDIA, companies like Meta, companies like Alphabet. You look at Mag 7, except Tesla, or in this case, companies of Broadcom. Look at the profile of these companies. Huge cash flow generator. These are $1 trillion companies and still growing at 30% revenue. And not just mindless growth in revenue, their operating margins are like mid 30%. Very different companies. So I just can't look at this number and say, hey, let's go short on tech because it's too pricey. I don't know. It's a different scenario. It's a different kind of a company. There was a stat that we reviewed, I think maybe a quarter ago or something, from Michael Mobesin around the concentration in US market. I think it was around like Mag 7 was like 40%, or maybe top 5 companies were 40% of US market, something like that. And we hear in the media, oh, it's too much concentration. I mean, I myself am concerned it's too much concentration. But if you look at how much of the earnings growth in that S&P is coming out from these 5 companies, They were also responsible for 36% of all the earnings growth, of all the earnings of S&P 500 companies. If you are responsible for 36% of all the earnings, then you being 40% of the index, that doesn't look to be, too much out of the place. At the end of the day, your valuation should be determined by your earnings capacity. And if you are responsible for 36% of S&P 500 company and you are 40% of the market cap, then it's just a normal, it's a normal business day. So always you'll have to cross check with, this compared to what. So again, I'm not saying that either way that it's too overly concentrated or it's justified. Sometimes the animal spirits will come in. I think there are some individual companies who are very, very heavy, highly priced, doesn't justify the valuation. But there are companies who I think deserve the kind of valuation that they are trading at. So you'll have to look into individual companies and then make a decision. Another interesting chart from a creative planning on the Tesla. Average price of used Tesla versus average price of all used cars. This doesn't bode well for Tesla shareholders. But I don't think there are any Tesla shareholders that exist that basically are investing in Tesla because it's a car company. So this chart, while it's a shocking chart, may be of little use for an investor. Investors are investing in Tesla because it's pick up the new narrative. Right now, the narrative is it's an AI company. It's a robotics company. If that doesn't work, we'll find out another narrative, right? So Tesla has been even though it's been one of the, good performing stock for me, stock/options for me, made decent money. I'm always conflicted with Tesla. Right. It's something that I don't think I can increase my position on Tesla, but it's a very liquid, deep liquid stocks. You can reduce your cost basis, heavily optionable. So I don't mind holding some in my portfolio for the bets on AI and Optimus if and when that comes out to be true. Shri has shared a chart. Top 20 holdings, 50% of S&P 500. Okay. Yeah, so this whole concentration, I think, sometimes get blown out of proportion because you hear only one side of the house, which is 40% of top 5 are equal to 40% of the index. But yeah, they are also responsible for 40% of the earnings. So it's okay, right? So looking at a fear and greed index.
The one thing I'm concerned about with EVs, because I've been investing in, I have a little bit of Tesla, but not a lot. And then Rivian is what I wanted to go deeper in. But with the big tax bill, now there's no EV incentive as of September 1st. So that's something that a lot of concern in the market is on electric vehicles in particular and whether that's there. And then most of them aren't profitable except for Tesla. And so it's like a really big long-term bet on whether they will be. But that tax incentive, I think, may have really hurt a lot of the market. And we haven't seen, as far as I can see, I can't see the reflection yet in the stock because Rivian's been down for like a while, but Tesla's still up. But that's something I'm watching very closely for that space.
But Rivian and Tesla are not in the same sector when it comes from an investing thesis perspective. I don't think anyone is investing in Tesla because it's an EV company. The whole investment in Tesla thesis is because it's an AI company and it's going to have an Optimus. It's a full robo taxi, right? Maybe you can license your robo taxi software later on. So it's the car production business. If I were to give, I think I talked about earlier also, for the car production side of the business on Tesla, yeah, I'll own it at maybe $100. And then another $150 for all the future bells and whistles. And that's why I'm like looking at if I'm in Tesla, $200, $250 to $300 or is what I'll pay. Anything beyond that is, I think, is super overvalued for me. So, but Rivian, nobody's looking at Rivian as a AI or any other tech. It's considered purely as an EV company. And my concern with Rivian has been is whether they will survive for longer or not. If they survive, for next 5-10 years, great. Then I will look at investing in Rivian. Right now, I have no idea how many of these EVs companies will actually survive for long term because it's a capital intensive business. Same is the concern I have with Lucid. And if you look at a Rivian history, every time they do a collaboration, stock will jump up because they will get a new lease of life by capital injection from. Did they not do a collaboration with Volkswagen or someone?
They've done a couple collaborations right
Yeah.
now, and including Amazon as well and others. So I bought into them just because in my area you just see them everywhere, and I wanted them to take over Tesla. But I'm looking at them from an electric vehicle standpoint. But you raised a really interesting point around like Tesla and the robotaxi, everything else. I don't really look at that as from a business because like Uber, I feel like is controlling it. But I guess that's maybe why Tesla stock is going up because I couldn't figure that out. Like,
yeah. So other thing why Tesla stock is going up is because it's kind of there are very rabid fans of Tesla stock orders. So right, so who knows short term will just buy every tip. So that's a completely different ball game, which now we have seen since GameStop era that there are many investors / traders who just don't care about anything around a business, but I just love the stock because I love the CEO or what he does, or maybe I have some nostalgia around it, all the meme stocks and all that. So Tesla does have that flavor. Rivian, little bit of a meme stock, but not at the same level as where Tesla is. Number 3, Tesla's got a CEO who can spin the narrative beautifully in the media, whereas Mr. Scarange, who is the CEO of, I think, Rivian, is not that impactful, right? So investing in Tesla is a completely different ball game. So from a Rivian perspective, my only concern have been that they continue to need capital injection until they fix their business to start making some operating money by themselves, right? So Sam says people are disgusted with Musk. There are people who also love him, and that's why it's the stock is where it is. Satish says, yeah.
I don't think that $5 billion is really a lot of money for Volkswagen, because didn't Volkswagen just invest in another EV company in the
Yes.
US?
So Volkswagen have been forging relationships across the world, right? They also had a relationship in China, I think with NIO. Their relationship built here in US with some EV companies. It is because they are just basically spraying their bets to see, again, we don't know which EV company will actually survive. We are very new in this game. If you go back and look into the history of the automobile, 1920, we are like 200 companies. Eventually in the US, only big 3 survived. So I don't even know, maybe Tesla will survive. Now, as a car company, I have a question mark on Tesla also, because based on what we are seeing in last few quarters, but I don't know anyone else, which one will survive. Will it be Lucid? Will it be Rivian? Will it be Zoox? We have no idea. Things will pan out by themselves. And that's why I'm not right now investing in based on the EV stuff. But yeah, Tesla has got a different other businesses that people are starting to value, and maybe, it will survive because of those things. Satish says from India, I'm investing on Tesla's SAP. Let's once a year has been good. Yes, I mean the stock has, I don't think it's like last 5 years, last 1 year, yeah, it's been good. But again, sometimes I think which Howard Marks has said, right? It's not that you have to buy a good company. You have to buy the company good. That means you have to buy it at the good price, right? And the position sizing. So if you look at Tesla, Tesla is, if you were invested in Tesla in 2022, you haven't made any money in 3 years if you bought it at a peak here. Now it's back to where it was in 2022, not even a peak, but yeah, mid of October, November's time frame. 3 years, no love for Tesla investors. Now, depending on if you bought it here. So even let's say if you invested in S&P 500, probably over the last 4 or 5 years, maybe you would have done better in S&P 500. Let's try to look. Let's try to do that and see. Let me just, I don't know. Let's at the bottom, let's try to plot S&P and Tesla. Let's plot this ratio. Yeah, S&P and Tesla. And this is what, oh, this is 1 year. Let's look at 3 years. Yeah, you would have done better in just buying S&P over the last 3 years. That's a challenge when you're investing in individual stocks, right? But over longer term, maybe 10 years, Tesla has done much better than S&P 500. Anyway, looking at the sector performance, like I mentioned earlier, it's the information tech and the communications that have been carrying a lot of burden this week, but overall industrial sector and utilities has performed. I don't think it's the first time in my life, investing life, that I'm seeing that utilities have done so well because of all the requirement for power for AI. Again, that's the investing thesis is still AI, right?
Vivek, you were saying that, I thought I heard you say you put in a put sale order for the healthcare ETF.
Yeah,
XLV.
I sold a put on XLV.
Right. How far below the market price at the time did you go?
I think I had gone to 30 delta, or maybe just let me look at that. Hold on. XLV, right? I'm looking at my notes. XLV. So I have sold 130 put when the stock was 132. It was a short put near 30 delta.
Okay, so is that based on your sense of what a fair value would be for the for the ETF?
Again, I think my idea was that, hey, this is too much too soon. I mean, it's been battered really, really bad, as we have given healthcare for dead. And when I looked at, I asked ChatGPT, how much was our spending on healthcare as overall GDP for 2024, still come up with the 17%, which I know that we spend around 18% on average on healthcare. So spending has not gone down,
right?
Even last year, but the overall as a sector has been beaten to death.
Right.
I could still be wrong. That's why I went with the short put.
Yeah. Okay, thanks.
Yeah. Oh, what strike? It was 130. It was 130 strike. Right. So again, I think the stock was at 132 or something at that point. All right. So from a stock buy and sell perspective, again, it's not an investment advice, but I do tell you at the end of every month what I hold in my portfolio. So, and I always tell you every week what stocks did I buy or sell. So I sold a little bit of a Arista network. I had a short put and a covered call spread on Arista network. And we look into the earnings, the stock was up 10, 12, 11, 12%, whatever the number it was below, beyond my call spread. So I sold some shares and closed the call spread. Same thing on NEO. I had a covered call on it, and I basically closed the call and sold the shares. Nothing fancier, nothing spectacular, but the stock did what I wanted it to do, and then I did what I was supposed to do. Right?
Vivek.
Yeah.
A couple of months ago, I bought like a few thousand shares of Neo. Do you think it is good for long term as the China EV market consolidates?
So from a Neo perspective, China EV market is very, very, very competitive, right? So again, I don't know whether it's been Neo, it's Li Auto, it's Xpeng. These are three you can invest through US market. Then there are other companies like Geely. You have what Zhang Motors, Leap Motor. Then
Excuse
of
me,
course
Vivek.
the bigger one is BYD. Let me just finish. So Neo, the problem with the Neo has a they differentiate themselves by doing, instead of including the battery as in the cost of the car, they'll give you battery as a service, right? They've been building charging stations across China so that you don't pay upfront for the big cost of the battery, which is a huge portion of overall EV car price. So you will basically use the battery as a service. When a battery is depleted, you go to the replacement center. It takes you 5 minutes to replace your battery, as it takes you a few minutes to fill your car with gasoline. So that was their unique selling proposition. They build a good cars. They recently, I think this week, they put out a new model E9 or something, E9. This is great if you look at the videos. My concern with Neo, which is a concern with every EV company, is they will continue to need capital injection. So they partnership with government agencies. They also had a partnership with Volkswagen to infuse capital in it, or they will dilute you by doing secondaries in the market.
Vivek. So in China, I can tell you right now, BYD and Geely are winners, but like Li Auto and Neo, they're prospects to be bought out.
Yeah, so they could be, right? They could be bought. I mean, Li Auto is the only out of these, except BYD and Geely, between Xpeng, Neo, and others. Li Auto is the only one which is profitable, and all of these cater to a different segment of buyers. But which one will survive? Don't know. It's a very dynamic market. It will consolidate in next 5 years. I don't even know which one of these will survive. But for me personally, Neo has been a good because it's optionable, and I've taken more money out of a Neo by selling option than what I invested in. So I'm just playing with the house money. To be very frank, and that's why I'm still holding. I'm like, goes to zero, fine. I've already made money on Neo, and I still own all the shares. But that's a concern I have on Neo, with the concern I also have on Xpeng. Xpeng, they're moving into eVTOLs, which is fine. Li Auto has been running operations better. They are profitable. Yeah. Every time you see Neo, keep an eye on its balance sheet. If they are running short of funds, they will either take a loan, as they've done earlier, or will dilute you, which they have also done, or get into a partnership, which they've also done. These companies will need cash infusion until they become or operating profitable, which these companies are not yet. So these are risky. Don't make it 10% of your portfolio. Again, I'm not advising you. I will never make it 5% or 3% of my portfolio. I'll take a small bet, which is fine. So next week, these are the companies that are reporting earnings. There are 3 that I hold in my portfolio: C Limited, JD.com, and Nanox. I thought JD and Alibaba report on the same day. That's what has been the case over past few quarters. So I was surprised to see that I didn't see Alibaba here. And then I went to Alibaba website, and there is no news on when are they going to report. And then I think NASDAQ has mentioned that they're going to report on maybe next week after that, which is surprising. I don't know what's cooking there. That Alibaba did not report it along with the same week as JD.com. Anyway, so these are the ones which I'll be interested in. What else catch your eyes? What else you want to focus on? I'll answer some questions. Meantime, let me know. Dave said, did you invest in NIO when it was $1? I invested it in when it was, I'm not sure whether one, but it was $2. That's when I started investing in it. It went all the way up to what, $50, $60, and then I came back to $3, $4. So I've been in NIO since I think 2019 or 2020. Right, and like I said, I'm just playing with house money. Right. So Oklo. Come on, what do you want to do in Oklo? They don't even, do they have any revenue? Last I looked at, I think it was Oklo, that it's all future growth and all that stuff, right? I don't think they had anything. NBIS versus CoreWeave. Not interested in both of the companies, but I will bring up, let me just take note. Santa says options only. No, I hold the stocks and then I'll be selling options also. And overall, over the last 5 years, I've made, enough money on options, which will basically is the more than what I invested in stocks. So that's why it became a house money for me. Baba is not even reporting results next week. NBIS, a Russian CEO. Okay. India just got another 25% tariff, so stay away from NBIS. I mean, again, the business model of Nebius, CoreWeave is all, hey, we have NVIDIA chips, we can rent it out to you. Right? When say to you, either there are some of the big hyperscalers or neoscalers, right? These are the only business model, which I'm not too keen on that business model from a long-term perspective. But right now that it's hot because there are not enough NVIDIA chips. And if you tell that you have NVIDIA chips, don't walk on the street alone. Keep a gun with you. You might get robbed, man. If you say you have NVIDIA chips. Says there are so much in demand. All right, so we'll review these. So let's look at a crypto market. Let's pick up the latest one because someone told me that Ethereum has gone high. So let's look at where Ethereum is. Yes, wow, it's almost 25%, 24% up over last 7 days. And the reason is Wall Street is now warmed up to Ethereum. One of a big, what do you call, the so-called financial talking heads, Tom Lee, who's been more right than wrong in traditional market, has been now, and he's also been an early proponent of Bitcoin before the rest of the Wall Street came in. He's now talking about Ethereum, right? He's a chairman of Bitmine Immersion, which is a Ethereum now, transitioning into Ethereum holding company. And if Tom Lee comes and talk about any asset, the other investors, they do pay attention. So Tom Lee is currently saying that Ethereum is at the same inflection point where Bitcoin was in 2017. So now if you look at, because 2017 is the first time when Wall Street started to warm up with this new asset class, with Bitcoin, and then we figure out the use cases and all that stuff. Now, a lot of tailwinds behind Ethereum because of stablecoin, because of focus on doing real-world asset tokenizations. Most of these projects are on Ethereum. Solana is competing with them, but you You're not going to put serious money on a chain which has gone down 7 times in last 4 years, right? Ethereum has never had a downtime in last 10 years. It just had its 10-year birthday last week, and it's never had a downtime. So that's the whole story behind why we are seeing traction in Ethereum. And a lot of companies are just raising funds to become Ethereum treasury companies, which means they'll buy Ethereum or few Ethereum ETFs or direct Ethereum, whatever, get an exposure to Ethereum on their balance sheet. And if that's the case, then it's got a lot more room to run upside. There have been talks that it might flip Bitcoin. Who knows? But this is the reason I think someone had earlier asked why Ethereum is going high, because the Wall Street is the big speaker on the financial media and on the Wall Street is actually talking about Ethereum. And he has a motivation because the chairman of Ethereum holding company. But outside of that, the friendly regulations and focus on stablecoin and tokenizations, which is what BlackRock, JP Morgans, they all are now focused on it. The use case, we are seeing a lot more use cases coming up for Ethereum. Okay. And if you look at it, though the Bitcoin have a decent run, Ethereum, I don't even think it's a new all-time. Maybe it's a new all-time high. Let's see if it shows us something. Because I remember selling 2021 around 4,000 plus. Oh no, so it was 4,878. So I remember selling at 4,200 or something. So I thought maybe that was all-time high. No, 4,878. It's not even at all-time high. Whereas, Bitcoin has already hit all-time high this year. So that may be the reason why Ethereum is doing what it is. Story has started to unravel. Okay, we already discussed Ethereum. Other reason is now we might see more on the crypto is there is an EO that's been signed by president allowing crypto along with other alternative assets like PE, etc., to be part of your 401ks. And this is the big market that alternative asset managers have been eyeing for years. But now they have an administration which is a little more favorable. And here we go. What a different world. We had in 2022 or 23, Department of Labor had issued a specific guidelines to retirement asset managers, talking about dangers of investing in crypto, and that kept because no one want to get sued, right? So now we have a present executive order asking Department of Labor to review the fiduciary rules for retirement plans, right? And if they withdraw their earlier guidance, saying, hey, it's risky, or you will be subject to more review if you open it up for crypto, if they withdraw that guidance, there are many asset managers who will probably try to push this in your retirement accounts. And the beauty about if you get a space in retirement account is like money just keep flowing in sleep. You don't go and check and change your allocation every bi-weekly or monthly or 6 monthly, what's happening in a retirement account. You set it and you forget it. And if you, let's say, by default, if my understanding is correct, the 401ks by default gets into your age-based retirement portfolios. Right? And now if Fidelities or T. Rowe Price or Vanguards of the world, they changed the model portfolio for age-based retirement plans, and they include 1% or 2% Bitcoin to be part of your asset. Dollars will just keep trickling in every 15 days when the investments get into 401k or IRA. That's why it is so huge. Right? Ripple and SEC and legal battle driving XRP and altcoin rally. Strangely, we haven't seen yet the altcoin rally yet. Where do we see Bitcoin dominance? Current Bitcoin dominance. Let me go to Bitcoin. Does it show me dominance here? Oh. 57%. Okay. That's cool. So let's go back and look here. Right. Maybe this is where we'll see a lot altcoin rallying, where the Bitcoin dominance around, like say 40%, etc. So we haven't seen that just yet because Bitcoin dominance has been just growing over last 18 months to 2 years since 2023. So while Bitcoin has gone high, the other altcoins have not rallied on that at the same pace. So maybe we'll see there is a possibility that altcoin will start rallying. Maybe once we get our Fed rate cuts, a lot more liquidity will be available. But looks like individual specific coins are jumping based on some news related to it. Right? Binance partners with BBVA for custody services. This is a little old. Block hits 1 billion Bitcoin holdings, and that's what the Block shares went higher after the earnings announcement. Then they realized, hold on. This whole increase in the net income, and that's why I don't like focusing on net income, is not because the Block has suddenly become better business. It's just the value of the Bitcoin has gone high. Right? If you want to degen, there is a new 2x leverage ETF available for you guys. And I think that's all okay. Yeah, so these were the main stuff on Ethereum, on the crypto side. Aditya, can you talk through some of the promising use cases for ETH? Tokenization, right? Real world asset tokenization. ETH, the latest use case now become as a treasury asset, which I never thought that ETH will become a treasury asset, but there are some companies who want to do it, right? That who can stop them. But for me, the biggest use case is DeFi, basically on-chain commerce, stablecoin, and tokenization. Now, if you just Google for it, there are reports, I think, from maybe Blockworks and was it from Fidelity, which have looked at these use cases and have come up with the price estimates. And I think it was last year, probably, I reviewed one of them. And yeah, some of them are very, very optimistic, assuming this percent of the overall DeFi happens on Ethereum and the value, and then, based on how much is the gas price is there, which translate to earnings of Ethereum, and then you apply some PE multiple, and then you come up with overall Ethereum so-called market cap. Right? But yeah, if you just Google for it, you will find many articles around the valuations. But I am looking at stablecoin, real world tokenization, and DeFi stuff. These will be top 3. Recent one is as a treasury asset on balance sheet. Let me see if I can find some of the price target, etc. stuff. So did I not review the institutional report of July with Fidelity? Because I read through this. but I don't know. So just search for Fidelity's institutional report on Ethereum. What do they say? Tokenization, digital economies, economic activity, access to financial services, which is basically DeFi, tokenization, and deepin. Okay, yeah, basically deepin is building your infrastructure which is decentralized. Yeah, just search for the report, you'll get it. Or you'll get, there are many reports around our Ethereum. I think this is the one that I had reviewed. Etherealized digital oil, store of value. I don't know whether store of value is now playing up. And since I think there are some crazy price targets based on valuation frameworks. Yeah, this is digital oil for your DeFi economy, store of value, global M2 and all stuff. Right. So yeah, there are many reports around Ethereum. All right, let's go into some quick earnings review. Oh, sorry, I had to answer one more question which I forgot. There was a question on ETF. I think that was from Elena.
Yeah, that was my question. Because I realized I've been heavily invested in stock, and I saw that your portfolio was more balanced with ETFs, and I'm assuming the ones you're investing in have high yield dividends. And so I was just curious in terms of like the balance of the portfolio.
Okay.
Kind of how do you recommend doing that? Because I'm assuming that's why you're investing in those. I think I was reading QQQ has like one of the highest dividends. And so I'm just trying to figure out if I should invest mine more and do ETFs in addition to individual stocks.
Okay. So here's a use case, right? Only 4% of the companies in the history of the stock market have been responsible for 90% of the gains. Only 4%. For investing in individual stocks, you have to find out what those 4% would be. I don't think I'm smart enough to find those out. And number two is if I invest in the market ETF, I don't have to worry about it, what falls off, which company has become better, right? Hey, if Apple is the best company, yeah, I will get more exposure to Apple through QQQ or SPY because these are all market cap based anyway. If a company becomes bigger and bigger, it becomes bigger part of these ETFs. If I'm investing in individual companies, which I do have, you have seen my portfolio, I do have a lot of individual companies as well, but then I have to do all the heavy lifting. And then I have to enjoy the process of doing that heavy lifting, which I enjoy, and that's why I hold it. So individual companies will have a much larger magnitude swings up or down. We're going to talk about Trade Desk. It was down 38% after earnings. But then on the other hand, you can also talk about companies like Applovin or Palantir, which is like up 5x in 1 year. We can talk about the companies which were like top of the leaderboard on US stock exchanges for decades and now nowhere to be found. HP, GE, all those companies. So if I'm looking at next 20, 30 years, I don't know which companies will be on the top of the list. Google had in the last 20 years one of the best business model. I don't know about next 20 years. That's the reason I want to keep a lot of my portfolio in ETF so that ETF will take care of my ignorance. Whichever company will be the next Google, whichever company is going to be for the next Google for the next decade, or Apple for the next decade, next 2 decades, ESP or QQQ will take care of that for me. That is why I would rather I own ETF. In fact, the more I started looking into the markets and studying individual companies, the more I started moving my portfolio towards ETF. When I was new on investing, I was like, wow, I can do this, I can do that. This, I thought I knew a lot about the markets and individual companies, but the more I spend time, I realize how little I know and how difficult it is to do. So those who've been attending these, you would remember in 2021, 2022, I had more than 100 tickers in my portfolio. And then I started doing all the cleanups. Now I still have a tickers I think is 60 plus. But when it comes from a dollar perspective, I'm moving more and more dollars to the ETF so that, I don't do the stupid mistakes on my portfolio. Investing is over long term. When it comes to the retail investors, investing is a loser's game. I'll repeat it. Investing is loser's game. Can anyone explain me the difference between loser's game and winner's game? It comes from a sports analogy. Let's say, I think Howard Marks talked about it, but then you can relate it to any sports. In fact, when I go and play, I use this analogy and then change my strategy of playing. Amateur tennis is a loser's game. Professional tennis, or pick any other sport, professional tennis is a winner's game. In amateur tennis, you win if you make less mistakes than your opponent. Because both of them don't know how to hit, maybe baseline to baseline, how to hit those, to serve that is unreturnable. All you need to do is not give negative points, not hit into the net. As long as you can just push the ball out to the other side, the other person will make mistake. So similarly, investing, you don't have to find the best companies. As long as you don't make stupid mistakes, market already has a tendency to go up because the economy keeps going up. And if you own the overall market, or let's say top 500 companies of the market of your specific sector, the overall sector, you will just do fine if you don't do stupid mistakes. So once I started realizing this, and I've seen on my own portfolio also, I'm like, I don't have to become crazy to try to find the next new shiny object and subject my portfolio to the risk of drawdowns. If I just don't do stupid mistakes, I'll be just okay. I'll be just fine. And that's the reason why I'm trying to move more and more towards the ETF, because there's a lot more probability of doing big stupid mistakes when you're owning individual stocks than if you're owning an ETFs. That's just me. Because I've over the past few years, I built up my portfolio. Now I'm at a stage, if I don't do stupid mistakes, my life will be fine. Then I don't want to do it.
That's interesting. Yeah, the article I was reading, or the video I was watching the other night, was around like I think they were doing estimates on how much interest you would need to make, or dividends, to live off of them. And I was looking at like, okay, if you wanted $2,000 a month, et cetera, how much would you have to put in there? And so they were talking about ETFs like QQQ that pay the highest in terms of how much that you need to invest in order to get like $2,000, $3,000, $4,000, $5,000 a month. So I wasn't sure, like, it sounds like you were doing it to diversify, just to make sure like you knew the market, but people use it as like a dividends gain, right? To figure out how to.
I don't think QQQ pays that dividend. Maybe there's some, because
well, according to this video, is one of the highest. There's lots of different ones. They pay. There was just an example of QQQ. There was other ones too, but they were talking. I was looking at like, okay, is a strategy to do, living off dividends. What would that look like if you wanted, like, I don't know, 5,000 a month of dividends? Like, how much would you have to put in, et cetera? And so that was. But it sounds like you're coming at it from a different point, which is that you don't need to know all the different companies that are coming new, they've done the hard work for you, so you know that you're invested in it,
Yeah,
and
so
not where you're coming from.
So I will caution you from those videos of talking about living on high dividends. And now it's not QQQ, but there will be these income generating ETFs, which I've seen over the last 2 years have exploded because the Fed rates have gone high. I would want to see how they perform when the Fed rates come low, because right now you can get a good income by selling call against your positions, and hence they will just pass on that income as a dividend to shareholders, right? But it's only as long as there's a skew in the options market on the call side, which it is because the because the Fed rates are higher. Right? I look at overall portfolio, not just a dividend income. I'm not a kind of a dividend income investor person, especially not around these MSTY and all that stuff, because capital side you lost a lot, but you made on the dividend side. Again, if you have a need for a regular income, sure, but I mean, I can generate doing that myself by selling calls against my positions, so I don't have to invest in those ETFs. You rightly got it. My reason why I invest in ETFs is to save my portfolio from my own stupid mistakes. All right. So let's get into earnings. We'll do a quick, this will be on a lot of stocks that I have. Okay. Anything else you want to do before I jump into earnings? I'll sip some water. And then after earnings, we'll basically break out into different rooms. We'll go through our breakout rooms and talk anything that you want to talk. So most of the investors, and if you look at a SPIVA report, 75-80% of the fund manager just can't beat their own index that they want to track. So am I one of those 15% like Warren Buffett who will beat? I think that's too much for me to even think that I'm anywhere close to that. All right, so let's get into these earnings. First one, Palantir, retail favorite. I love the business, not the stock. Revenue was up 48%, and the first time that they hit a quarterly revenue was more than $1 billion. And also they increased their guidance for full year 2025, right? So basically they good growth in revenue, they beat on revenue, they beat on adjusted EPS, so that was a double beat. From a business metrics perspective, commercial revenue grew 46%, government revenue grew 49%. I really don't like, I want to see commercial to be bigger portion of a government, but it is what it is, right? Customer count has been growing, billings have been growing, everything is doing good. There's nothing from nothing in the numbers that I don't like it. And some comments from management, they have a more demand than that they can satisfy. They're looking to grow revenue 10x while decreasing the number of people that they have from 4,100 to 3,600. I just love the business. And stock was up 4.5% to 167, but it's already very expensive stock. And now it's already very, very, very expensive stock. Now it has become very, 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 very expensive. And I think right now it is trading at 180. I don't know, 187. Right? So for me, now investing in Palantir is just a gambling tip. I'm just scratching my gambling itch. There is no way I can justify paying 125 times the sales. I don't care how much you grow. There has been never a business that I have been able to grow into these valuations. Right? So yeah, I'm not chasing this. And I still hold some of the shares. I had a caller at 175. I don't think I will let it get called away at 175 because right now I have an opportunity to do a tax loss harvesting and to not pay any taxes to governments. Maybe I'll close the call or I roll the call to somehow to the next year so that I can take a profits next year. I'll probably have a caller on this one just to protect the gains that I have had on Palantir already. It's been one of the best performing stock in my portfolio. You own Palantir at 20. I bought it at, 2023, January, we talked about Palantir at $7 in this Saturday meeting. Right. So yes, I've been buying it since then. I bought it, I think last I bought it was at 26. Then I started selling it at 45, 65, 90, 105, 120, and last probably will be 175. But I don't think I'm going to sell at 175 because all those I sold, that has now amounted to a lot of capital gains for me and showing me as a capital gains tax. So I will take a loss on the call and put another call on to just do the not pay taxes. That's my story on Palantir. Ramesh, you have been selling put, don't own any stock. It's been a great winner for me. I can't justify holding the stock at this point of time, and that's why I'm sitting on a collar, and hey, it's a gambling stuff. I made way more money than I invested in it. Max loss is just 3,000 per year for tax purpose? No. Right now I have a gains, right? So I want to get to the zero. Then yes, the loss will be 3,000, but I want to, my portfolios are showing capital gains. I don't want to show capital gains. So I'm looking at opportunities to do a tax loss harvesting. Second one, Mercado Libre. On the other side, which I own, this is my biggest holdings in my individual stock holding in my portfolio. I still love the stock. Revenue was up 33%. Right? Margins were challenged. Look at a gross margin, operating margin, net income margin, they were all challenged. So they beat on revenue and they missed on EPS. And the market sold on the stock at 6.5%. Right? Reason why the margins were lower is because they expanded the free shipping in Brazil. I'm not going to get into the details of it. So to get more customers from offline to online, they're giving discount on shipping charges for their sellers so that the sellers can now, basically discount on a lower price items so that seller can now list more lower price items. And then they also have a more first party e-commerce sales this quarter, which has got a negative mix. Then they spent on more marketing. They also had celebrities promoting their Mercado Pago, and the credit card segment is exploding, which is a lower margin. When I look at all these things, I'm like, I think this is money well spent, right? So why not? I'm okay with management doing this. So I'm still bullish on the company. Their ad revenue is grown 38%. I don't think any financial media or any analyst is even talking about ad revenue. And if you look at this, they actually don't show the ad revenue. I posted again. I'm like, they do the best job when it comes to showing the metrics. Of all the companies that I own in my portfolio, Apple does the worst job. You have to dig through Apple to find out. Mercado Libre does the great job. They'll put on all the metrics right in front of you in one slide. As an investor, this is like candy to me. Right? But even they don't put something on advertising, which I have to track separately because it will be buried in an earnings call. They'll talk about it or on the shareholder letter. And if you look at this earnings ad revenue, it's been growing up nicely. Since it's not there on the main deck, no media talks about it. but this is going to be a good margin accretive business in the future. It's already hitting 1 billion trailing 12 months. So yeah, I think this business continue to perform. Probably one of the best quality business that's in my portfolio. Santa is asking, what's your position on this? All long, it's a difficult to do options on this one because the stock is $2,400 and the option bid ask is really very wide. Right now it's like $7, $8, $10, $15 wide. But when I say it's the biggest position, I always talk about the stock position. The portfolio chart that I showed is only the stock position. So it's my biggest individual stock position. The biggest holding is SPY. The second biggest is Mercado Libre. Right. Third one, reported results. If you have any questions, just put it in the chat. Otherwise, I'll continue to go down the list. We have a lot of earnings to cover. Okay, is Uber. Uber, again, great execution. It was basically beat on top as well as bottom line. Revenue up almost 18%, operating a margin up 4%, which is huge, 400 basis points, right? Operating income is up almost 80%. Overall trips is up 18%. Trailing 12-month free cash flow is now $8.5 billion. This company, before they got in Dara, that CEO, was like a cash incinerator. And this is where, you need to have a mindset of, do I want to invest in a growth? So-called traditionally value versus growth. Traditional value investors will never touch this company. But if we know what kind of a marketplace they're building, and if we can envisage the different businesses that they can get into, with the right CEO, they've turned it around. It's generating $8 billion of free cash flow, which now they can use to do whatever they want to do. Right? They can invest. They can buy companies. They can return it to shareholders. Right? So guidance was above the estimate, which, so market liked it. Stock was up pre-market, but it was down. So I was like, why it is down? I only realized it after I went through the transcript of the earnings report. I don't think I posted that yet. I just finished it yesterday. So I will update on Twitter, but I'll tell you quickly here. When you look at what the CFO and the management talked about is that of all the free cash flow that they generate, 50% they'll return it to shareholders. Means they're going to buy back the shares, which is great. Rest 50% they'll use for growth. And one thing that they mentioned is we're gonna take, put investments in maybe buying some of the AV companies. So they recently announced partnership with Lucid. They say we will be open to having more such partnerships. It means they could eventually end up buying cars. So far, Uber has been a capital light. Remember, initially we talked about capital intensity. Uber has been a capital light business because they don't own cars. It's the drivers who own it, right? So the huge expensive stuff to run which is the cars, they don't even own it. They never invested in it. They just own the software tech platform. So that was a big thesis of my investment in Uber. Is there a marketplace and a capital light business? Now, if they are thinking and they are telling that we will start to take this partnership, they probably wants to get those cars, AV cars, autonomous vehicles, onto their balance sheet. It will become a capital heavy business. So if that was the only thesis, I had other theses also, I still like the business, then you might want to rethink. And I think that's the reason why the stock probably also sold off is around maybe the capital structure, the mix of Uber is going to change now in future. CFO tried very hard to calm them down, saying, guys, don't worry, we have a lot of a cash flow to invest in it. We don't have to do secondary offering. We don't have to take a debt. We will return 50% of the cash flow back to shareholders, and then we will divest from some of the non-core businesses to invest in this new AV side of the house. Okay, so that's on Uber. But if you are I do want to let you know some of the change that I saw in the perspective of how management is approaching investing into business, or what kind of assets they want to have on their balance sheet.
Uber's recommended as a strong buy right now by analysts.
I don't know.
It is. I follow.
Oh, it is. Oh, you're telling it is?
It is. Yeah, that's one of the companies I just started investing in, because some people from my company have gone to Uber and they're in like sales and they focus on AI, and so I've been starting to like invest in them. Not a ton, but I should have, because it's now at $90 a share, and I think when I was looking at it, it was like 60 or 50, and so it's climbing, and it's been kind of but it seems like that is, at least right now, analysts are recommending Uber as a strong buy.
Yeah, sometimes analysts are late to the party, which I think to me things to be that in this case they are late to the party. I was a lot more bullish around Uber earlier than what I'm right now, because of the competition coming from these robo taxis and all that stuff. How are they going to compete? They have been forming partnerships with all these autonomous vehicle software providers. But what I did not realize until I went through the earnings report is that they are also open to owning cars. So one of the business models that they mentioned is we might buy the cars and then license the software from the software companies and run a fleet. And that was like, oh, now you're becoming like a capital heavy business, right? Something that has changed in the history. Now they're changing it. So yeah, I don't know about what the analysts are recommending from a buy or sell perspective. So, but thank you for letting me know. I see a comment. Compared to Uber, Dash, Cart, and Lyft are doing better growth. Uber might buy Cart. So far, Dash and Cart are treating me well with their Chase partnership. Keep using them. I don't know. I'm not too keen on Lyft. They have a very niche. They operate in a very niche segment, and have always been considered as a second cousin to Uber. Why not own the bigger one? Let's look at Shopify.
Recently, Lyft moved to Europe. They bought the one company and they started using it. They're expanding into the Europe as well.
Yes, I think we thought about it. Yeah, but again, rather than buying, it's all, do you want to buy the number one or number two? There are theses around both of them. Is maybe number two will grow to become or will grow faster. Possible. But I think, yeah, I'm not invested in Lyft, and Uber has treated me well. They have a much bigger, I would say, business, more diversified business stream of income coming in, right? Lyft has got only mobility. Uber has got delivery, Uber Eats, and now they're talking about Uber Work, not the Uber Works, but the reincarnation of Uber Works. They have 9 million drivers, and those 9 million drivers can actually do the tech work for the tech companies, which is like anywhere they're driving, right? So they are capturing the data that might be needed by autonomous vehicle companies. They can do the data labeling and all that stuff. And this is what the CEO calls as externalizing the technology, means using Uber technology and sell those to some of the tech companies that might need it. In 2019, Uber came up with something called Uber Works, which was like a platform for contract workers. Businesses can post the jobs, and if I have a 2-hour, 3-hour window between my rides, I can go and do the job. They shut it down after COVID. To me, looks like maybe they're bringing it back. So they have a diversified business segments. My only thing is the Lyft is only one. Anyway, so let's
the way it works out is that DoorDash has a major partnership with Lyft, and then the Uber is partnering with Instacart. And the Instacart is hosting the Uber Eats on there. And then looks like the Instacart is a grocery business. 80% of them is managed by the Instacart. So it will be a good match for them. But Lyft and DoorDash is partnering quite nicely.
Yeah, maybe there is like a place for more than one. Who knows? Asif say aggregators can only survive, they become producers eventually. To cut the cost, yes. Right. To improve eventually long term to improve the margins, right? Maybe. But you'll always have that short term drag on your margins once you start to produce everything yourself. Because you have to set up initially for Netflix is what the cost of content, and it still is. You have to spend billions and billions of dollars rather than Uber trying to, right now Uber's AV is through Waymo. Right? Waymo is also entering into this robotaxi business. So Uber has to find out a way to compete with them. So I don't fault management saying why you want to own the cars, but just that it's a change in a strategy which I want to be aware of. And you should be aware of if you're invested in Uber. Shopify. Let's talk about Shopify. So Shopify had stock was up 20% because the revenue was up more than 30%, which is again a beat on top line, huge beat on bottom line, but there's a catch on EPS. So you should focus more on operating income. Was up 21%, not bad. I think all other numbers look good. GMV was up 30%. Merchant Solutions up 35%. Why you should ignore this EPS? Because the impact of equity investment, that's what caused the EPS to be up by 430%. It means Shopify had investments in some other companies whose stock went up, even without Shopify doing anything. So you want to look at, after netting that out, it was still up by 98%, right? It's not bad, but not as great as 430%, right? Again, more of the revenue growth was due to larger merchants joining the platform, and they also gave a guidance which was better than expected. So you beat on top line, you beat on bottom line, you give a better guidance. It's like a triple beat. Market liked it. And now it has become the most valuable company in Canada by dethroning RBC, which is the Royal Bank of Canada. So yeah, I'm happy as a shareholder. So that's Shopify. But let's be also aware of a curse in Canada, which is every time a tech company becomes the biggest on Canadian exchange, Toronto Stock Exchange, then the future doesn't end up well for them. We have seen it in BlackBerry, Norton Networks. Again, I'm not saying anything for Shopify. I own it. But this is something called like the curse of the tower for Canada. Anyway, let's move on to Arista Networks. ANET. Again, a great quarter for Arista Network. Stock was also up 13%. And why not? Because the beat on revenue, again, 30% growth in revenue, and the beat on EPS, again, let's look at operating income, is up 41%. So even higher than the revenue, which means good leverage, operating leverage. Strong balance sheet, non-GAAP operating income, $1 billion for the first time. They also did an acquisition, added onto their leadership bench, and they also repurchase shares. What is not mentioned in this one, which I found out later, was they actually have also upped their guidance. I do have a guidance. They increase their guidance for Q3. So not only beat on bottom line and top line, but you also increased your guidance for the year, for next quarter, and also in a longer term. CEO brought in the target of $10 billion they pulled in by 2 years. So I think the target was 2020. 2030 or something, 10 billion by 2030. Now they're saying by 2028. Or maybe I'm missing the what year, but the idea is that not beat on top line, bottom line, increase on quarterly revenue guidance, and then pulling in $10 billion estimate. I forgot where it was. Somewhere I did have that. Oops. $10 billion. Oh, it may not even search for that. But yeah, they did pull in by 2 years. Okay. Won't spend a lot of time on digging through that information, but I recall while I was going through that. 2026. So from 2028 to 2026 then. Next, look at Coupang, which is an e-commerce company out of South Korea. Standard results, no surprises. Good thing that I liked about is that they have moved into Taiwan, and they're seeing some good traction in Taiwan. I think that's a good takeaway. Other than that, it's a nicely growing business, decent management, focused on increasing shareholder value. We're not going to go through all the details of it, but expansion in Taiwan is actually better than their own most optimistic estimates. So that means, they can grow out of Korea. What I didn't hear in this one was I wanted to know what's happening on their foray back into Japan. They came out of Japan a few years ago, not trying to get back, but there was no information on this one. And I'm not an analyst, so they won't even answer my questions anyway. So maybe I'll write to them in an email. But yeah. So yeah, I'm still hold the stock. Happy shareholder, and I think they'll continue to perform well. At least when I listen to management, they are pretty business. Of course they're business savvy. The CEO is a Stanford grad and also very focused on shareholder value. Airbnb.
Is it C Limited also in Taiwan?
No, C Limited based out of Singapore.
I know, but they have an operation in Taiwan.
I don't know how much revenue from C Limited is coming from Taiwan, but I think they are also in the whole Southeast Asia and also in Brazil. Coupang is not in Brazil, but C Limited is in Brazil also.
Oh, okay. So a lot of competition from MELI and C Limited and Coupang.
Yeah. Oh yeah. So that's why. So the one of the reason why MELI reduced the free shipping price from 79 Brazilian real to 19 was at that price point. A lot of a C Limited, Shopee had a lot of goods at that price point, and they wanted to basically beat on that one. So that was one reason. But still, against that competition, MELI is still growing. I don't really care. Both of them grow because they own shares in C Limited also. I'll review the earnings next week. Okay, so Airbnb, they beat on both top line and bottom line, but the stock was down 6%. And then I think after hours, but then it recovered later. So revenue is up 13%. Operating income is up 23%. Net income was up 15%. EPS is 19% because they bought back some shares. All business metrics look good. One thing which I did not like, but I like to know, update my tracking is instead of called night and experiences, now they call nights and seats booked. I have to figure out what's the difference. There's nothing bad in Q2 performance. I didn't find anything that is concerning to me. They have $11 billion of cash and cash equivalents. One thing which I like about Airbnb is it's a market. I mean, number one, it's a marketplace. Number two, it's a very cash-rich company because you give your cash to the Airbnb first. Like I'm going on Airbnb tour 2 months later, and they'll take money from me now, and then they don't have to pay the host. After I have actually made use of the service. So they have a lot of a cash which they can make use of, right? Free cash flow for Q2 was $1 billion. The guidance was a little light. And I think that's what probably this spooked the market, that after growing for 13%, now they're giving a guidance of growing 8 to 10%. Number two, there were a lot of questions from analysts, and I got to know after I went through the earning transcript again yesterday night, so I don't have it on Twitter yet, is a lot of questions were coming from analysts on recharging the growth in North America. So they're seeing grew 13% because of a growth coming from outside of North America. Their new geographies, new geos. They're kind of stagnating on North America. So there were a lot of questions. How are you going to recharge the growth? And Brian Chesky said, he talked about a few strategies, but I think that's what the market is a little concerned about. It is the biggest market, and they're kind of stalling in terms of a growth. Right? But yeah, I hold shares of it. I think I'll continue to hold it. If you're a stock investor in this one, I don't think it has treated you well over the past 4 or 5 years, unless you've been, doing options and trying to reduce your cost basis, right? So if you're just holding the stock, geez, it came an IPO that is like a below IPO. And it's been just sideways, right? It hasn't worked out well from a stock perspective. Oh no, so they opened it here. But anyway, then it fell down promptly. So not being a great investment, but I think I still like the business.
The problem with the Airbnb is that they can cancel, the host can cancel at the last minute, and nobody likes that if you have planned everything. And they don't have any control on that. And I prefer to go back to the hotel business because that's they can't cancel.
Yeah, so one of the things that he talked about is get more hotels on their platform. They also own a company, I think called Hotel Tonight or something. And they say we are also looking at getting more and more hotels on our platform. There also they've been culling some of these low-rated hosts. They're removing all those listings to improve the quality. They're doing some stuff, but there's a lot more to do, right? Again, that's why it's not like my top 10 positions, but I still hold it if they fix all these things, it's a good cash generator. It's kind of, they have a negative working capital, and they can make a lot of use for that cash once they perfect the core service. All right, next one, Jumia Technologies. Those are not aware, this is basically e-commerce focus in Africa, right? So we got an e-commerce focus in Latin America, which is Mercado Libre. E-commerce focus in US, which is Amazon, and Europe and US, North America, which is Amazon. I have e-commerce on Asia side, which is Alibaba, Coupang, and C Limited. Now let's go to the Africa. I just want to make sure I have bet spread across all the e-commerce players, which is Jumia. Stock was up 30%. It's been a very volatile stock. It's been all over the places. At $2 all the way to $50, and now back to $3, $4, $5, wherever it is right now. Revenue up 25%. The reason I think why the stock was suddenly up is we start to grow the revenue again. It's got a long history of many strategic changes in its business model over the past few years. Fired the founders and the longtime CEOs, got a new management, and have been on cost cutting over the last 2 years, or at least 18 months, and at the expense of revenue slowing down. They came out of a lot of non-core businesses, closed down the businesses, many in African countries, and now we are seeing revenue growing again, which is, I think, was a good surprise. Customer loyalty is increasing, and the cost is still going down. I mean, they've been cutting costs like I never seen any other company do this way to the bare bones. And now they're also looking at advertising, right? So they also raised their guidance again for their 2025. They raised it in Q1. They raised it again. And I think now the Wall Street might getting interested in it. Again, I've not gone through the earning transcripts. So I don't know how many analysts were there, but I did not join the call, this one, because it's like way early in the morning. But I used to join their earnings calls, and there'll be hardly one analyst on the earnings calls. There were no analysts on the earnings call. And then I started seeing one analyst joining the earnings call. Last quarter, and I think 3 quarters again, there were 2 analysts. Last quarter, I saw 3 analysts. I'll have to see how many more analysts are now joining the earnings call. If I see more analysts joining in, it means Wall Street is getting interested in the stock again. Growing revenue, reducing cost, increasing the repeat purchase from customers, opening up new high margin revenue stream, and raising the guidance twice. Music to my ears. I still hold the stock. I think I'll hold it. It's a moonshot bet. So if it goes to 0, I'll get a scratch on my skin, but won't kill me. Any questions? And I've been holding this for now about 4 years. And if you look at the stock, you really need to have a heart of steel to live with such a stock. All the way to $2. Oh, this was $15 recently. Oh, come on. There were more. Hold on. Yeah. Up to $70, $2. And now it's back. And then, this is what happens when you're on individual companies. All right, Doximity. Great beat on top line, slight miss on bottom line. But if you look at a non-GAAP, it's the beat on the non-GAAP EPS, which is what market was focused on. So I wasn't really sure why the stock went high until I went and looked at the non-GAAP EPS, because hey, you missed on your bottom line. But beat on top line, free cash flow growing nicely. Trailing 12 months retention is 118%. Again, so this is a company which basically started as a LinkedIn for doctors. They have almost 85 to 90% of the US physicians on their network. Then they started adding other stuff like telehealth, be able to call your patients. All are HIPAA compliant, and workflow management tools. Now they brought in a GPT, and now they did an acquisition called Pathway, which is basically clinical analysis of the data, right? And they launched a new product called AI Scribe, which is doctor to take notes. Once you're done your discussion with the patients, you will take notes. And I wasn't one when I went to Berkshire Hathaway shareholder conference. I got to meet some doctors over there who were also investors, and I met only 2 of them, but both of them are users of Doximity. So take it whatever it's worth, but that was 100% hit that the doctors like Doximity, and they also repurchasing shares. This is one company that has been net GAAP profitable, even though it's a small growth business, but it's been a GAAP profitable for many, many years. I think ever since they've been in the market. So there's nothing not to like about the company, but the thing that you may have to watch out for is how quickly they're able to roll out their workflow tools and the adoption of those tools. But I'll hold this. Oh. That's on Doximity. No questions. Let's move on to the next one, which is Trade Desk. The final deep dive or the earnings, it was down 38%. So let's look at TTD. Right. Imagine having 20% of your portfolio in Trade Desk. It's been a great winner. Don't get me wrong. It's been a great winner over the last many years. But then you're back to where you were 5 years ago. Right? So that's a challenge. So Oops, what happened with TDD? All right. The numbers were up. I mean, if you look at the revenue, there's nothing wrong in this quarter. Revenue was up almost 19%. It was higher than what the market was expecting. Adjusted EPS was 0.41, 41 cent, which is also better than expected, though just by a penny, so not too much. There was strong balance sheet. Free cash flow was up triple digits. Customer retention is still above 95% as it done for last 11 years. So there's nothing wrong with this. But market being Mr. Market, they didn't like it. So let's see what else happened. They're also gonna repurchase some shares, which is great. And they gave the guidance, which was above estimate, but barely. But few things that they announced was leadership change. So they're gonna have a new CFO coming in. So here was my take. Number one, the guidance didn't excite, right? The guidance was in line, or let's say barely beating what the expectation was. And the market thought that it will beat up much bigger because Meta and Google, their advertising revenue grew much faster. And they're given a better guidance than what TDD has given. Number two, there's a change in CFO. I mean, leadership changes happen, but when a company at such a high growth company, which is trading at a high valuation, have a change in either CEO or CFO level, there's a short-term uneasiness in the market. You don't know how good the new CEO is, what's the capital allocation decision, how do they treat their investors, so on and so forth, right? Management also talked about a tariff and how the tariff is impacting some of their big customers. And it's also concerned about the fact that these issues may be specific to trade desk, because if you look at Amazon, they also posted a healthy growth rates. And Amazon is also moved into its space as I think it was last quarter or quarter ago, Amazon decided to become a demand side platform. So when you're having a competition with a company like Amazon, it's tough. So I think that these are the reasons why market didn't like it. But is it a reason to have it like 38% down? I don't think so. Because their new release of Kokai, the AI-based platform for your buying and selling of ad and creating of your campaign of your campaign to buy those ads. They're running more and more customers through that, and that's more profitable for trade desk as well as at a lower cost for clients. And so I think they're still doing some good things. I think it does deserve the punishment that they didn't beat really with a higher margin, but I don't think 38% is a haircut that they deserve. So I actually sold a put at that. Specifically, if you go back and look at last week, I had sold some trade desk shares to do some tax loss harvesting, right? Now I'm saying maybe I can sell a put. If I get assigned, I'll buy those back. I think I sold some at 87. So now my put is at 55. So if I buy it back, and it will be after 30 days or when I sold it, so it won't be a wash sale. So I actually sold a put on this one. Okay. But Amazon getting into this is a concern. All right, so these are the ones that I hold in my portfolio. Now quickly look on some of the things that you had mentioned last week on the tickers. Applovin, right? When I looked at Applovin, I think I might want to do deeper into that. I remember I've gone through one short report of Applovin that kept me away, but seems to be a good business if it is not a fraud. The numbers and the metrics around the profitability, growth, capex, gross margins they all are attractive. So if we look at even this one, revenue grew 77%, operating income is 150%, EPS again 170%. The numbers all look good. Free cash flow up 70% year over year. So, but it's an expensive stock. It's like 20 times sales. It's not cheap. But the thing that concerned me is they're growing their revenue 70% and they are into mobile game advertising. Whereas mobile game advertising as a market is not growing that hard. So either who are they taking the market share from? I don't know. I don't understand. Are there some round tripping happening in this one that they're able to post these numbers or something else going on? Seems to be too good to be true, but the numbers look great, man, in this one. Right? And I think the market has rewarded the stock also very nicely. Right. All right, so that's Applovin. Then the Duolingo, again, stock up 40%, gross profit 40%, income up 78%, nothing wrong. Again, 20 times sales, but earnings-wise is pretty expensive from an earnings perspective. I don't own any of these in portfolio, but I think market liked it. What it saw from a Duolingo, and I think the stock also performed. Wow, okay, it jumped up higher and then it sold off. My only concern was around the whole ETF stuff. Also, not ETF, this AI stuff. How are they going to survive in the AI world? I don't want it to become another Chegg, right, which is now down, 95, 99%. I don't know. I have no idea. That's why I don't hold position in this one. All right, quick look at AMD. AMD number individually, except that the operating income, which they had to take a charge because of, I guess, China. There were some concerns around AMD that the data center revenue growth has slowed down, whereas your competitor like NVIDIA keep on posting bigger and bigger numbers. And the other thing around the AMD was, if you delve deeper into the net income, everything else, so that's the reason why you need to focus on operating income. Net income is up 230% year over year, whereas operating income is down 150%. So when you look at these numbers, you say, what the heck is going on? So when you look in the income, that's why you shouldn't look at an EPS. You realize that the net income has been propped up by the release of the income tax reserve that they had kept, right? So there were two things which are not related to the business that has propped up the net income and EPS and everything else. So these numbers are useless. Net income, EPS, etc., are all useless to look at. I think what the market didn't like was the slowness in the growth of data center revenue. And I think that's why the stock probably was punished. But overall, the revenue, yeah, I think the stock did get punished after the earnings, but overall revenue grew 32%, which for a normal company is great. But if NVIDIA comes back and say they grew like 40%, 60%, then, market look at it relatively and say, wow, come on, AMD is falling behind. And what I don't like about AMD is the margins. Look at the operating margins. It's a single digit. If you look at NVIDIA operating margins, you look at 30%. So you're growing revenue, but then it's like you're just buying the revenue, spending too much to grow the revenue. So nothing left out at the bottom line. So that's a concern. Elf Beauty, I don't hold this. Again, yeah, slow revenue growth, 9%, 6%. Maybe this is a turnaround, because over the past few years, look at the 3 year, 5 year, they've grown 40% CAGR. So something happened in the last 2 years that they kind of lost the plot. Again, I don't own the shares. I never analyzed the company, maybe have something to do with the China or the weakness in China, in the consumer spending in China. It may be a big market for them. And that's the reason why over the last 1-2 years, the revenue has actually slowed down. But this quarter perspective, and they're pretty expensive also. 70 times, 30 times earnings for, or 50 times free cash flow for a company that is growing at 9%. Super expensive. Disney, back to grow 2%, 3% growth, not that exciting. I think Disney did mention that their consumers are spending, but yeah, nothing that's, excites me to own Disney. At least better operating margins than AMD. Who would think that AMD, which is an AI, has got worse margin than the Disney? But if you're a growth investor, doesn't look to be growing that fast. Maybe it'll turn itself around. But not too expensive though. It's cheaper than the overall market. But you need to be also aware of risk of succession. Bob Iger is not immortal. Who will come in? Every time they bring in someone new, that doesn't work out. So that's on is Disney. The last one is last one is on Dave. I don't even know. I think Dave, you asked for Dave. Looks like this is a financial services company. Now I'm a little bit interested in this one. Good margins, decent growth. And the numbers look good. But it's got only little history of 2 year, 3 year. It's not been in a public market for long, but it makes me interested because I never knew about this company. 40%, close to 40% operating margins, 30%, gross margin, and 90% gross margin and 30% operating margin, which is a good one. And revenue has been growing at a decent pace. But it's very expensive though. But something that I can keep on my watch list to see after 1 year, 2 year, how do they perform. So that's all. I'll stop here. I've been summoned already, so I have to go. But that was a quick rundown of lot of earnings. What do you think about Oklo? Oklo is a VC investment. You want to invest in Oklo, keep a venture capitalist mindset. It's based completely on story. I don't think they had any revenue last time I checked, which was maybe last month or a few weeks ago. So yeah, there's no revenue. What? Yeah, they don't make any money. It's a VC. It's a startup. Go with that mindset. It's all about
a startup, but it's picking up. I mean, I'm trying to understand why is it picking up? But it's actually
it is because I think they are on SMR, a small modular nuclear reactor, which means if all the AI companies will need power, so they probably have a relationship with
the government,
our utilities company, that they will be able to generate power using SMRs or nuclear reactor. So there are 2 or 3 tech going on in this nuclear space, SMRs and nuclear fusion and all that stuff. And that's the story behind it. That Googles and the Metas of the world, they need a lot of power and they will have a long-term contract, either with Oklo or with utilities which will use Oklo tech. It's all about a future story. There's nothing. They don't have any revenue right now.
Yeah, I guess it's a play for future.
Yeah, that's what I said. It's a VC. Go with the VC mindset. All right, guys, I have to go. Thank you, everyone.